Fixed income issuance and trading. Fixed income instruments and markets are generally classified based on three main dimensions: issuer type, which is the different type of sectors, credit quality, and time to maturity. So by looking at these three dimensions, we're able to categorize and narrow down the different bonds into different categories. Because there are so many different types of bonds, we need to distinguish one category from the other. Unlike equities, where issuers typically have one or two instruments, fixed income issuers often have multiple instruments outstanding, as what we have described in terms of the different dimensions. For instance, a corporate issuer may have various loans and bonds, both short-term for working capital and long-term for capital investments. I think working capital comprises of current assets minus current liabilities. So current just means that it's a year or less. In capital, the way to gauge whether the company has enough capital to fulfill its short-term obligation, which is less than a year. And for long-term capital investments, these are borrowings that you do, but this is for a longer term, like more than a year or more. Some large companies also issue commercial paper. So commercial paper is a short-term bond, and it's used primarily to finance working capital, which can be secured by specific assets. These debt instruments might be issued in different currencies to hedge against currency risk and attract a broader range of investors. Okay, we'll talk more about commercial paper here. Commercial paper is a type of short-term debt instrument by large companies. So to finance their immediate working capital needs, this is the short-term capital needs that we talked about earlier, such as payrolls, inventory, and other short-term liabilities. These instruments typically have maturities ranging from a few days to up to 270 days, which is less than a year. While commercial paper is usually unsecured, meaning it's not backed by specific assets, some issuers may secure the commercial paper with specific assets to reduce risk. But by securing with specific assets as collateral, you are actually reducing the discount rate, which is the interest rate you need to borrow. So this means this is why we say potentially lower the borrowing cost. This can make the commercial paper more attractive to investors by providing additional security. Companies might issue commercial paper in different currencies to hedge against currency risk. So this is applicable when you have operations in different countries. For example, US company has a significant operation in Europe, might issue commercial paper in euros. So this matches its revenue stream expenses in euros. Okay. So this is a fictional BRWA Corporation debt profile. We can see that they have various debt instruments that cover various maturity. We have like short and long term. The reason why we have this is to ladder the obligation such that you have longer term, fixing the longer term borrowings. At the same time, you also have shorter term borrowings, which you can roll over at a shorter interval to take advantage of if interest rate were to go down. We can see that, for example, the shorter terms are like commercial paper, and you go up to 5-year notes, followed by 15-year bonds in this case. Okay, BRWA exemplifies an investment grade corporate issuer. So investment grade is higher grade bonds, unlike higher yielding junk bonds. So it means that the corporate issuer will have easier access to unsecured debt. So they don't necessarily have to issue secured debt, which has a lower interest rate and a higher cost for the issuer across various maturities, markets, and currencies. So different currencies will entail different interest rate based on the country's interest rate. Okay, the company utilizes commercial paper for short-term or seasonal working capital needs. So these are the shorter-term needs. Intermediate-term debt for more permanent working capital. So this is for longer term than shorter term, and long-term debt for capital investments with longer useful life, such as manufacturing equipment or factories. So when we talk about capital investments, we're talking about investments into equipments or factories. These are some of the more common examples of capital investments. BRWA also pays fees to a syndicate of banks for credit facilities, such as loan agreements with pre-specified terms and limits, but fluctuating balances based on the company needs, similar to a credit card. Okay, this part about credit facilities we will cover in later slides. So there's two facilities here. Okay, the first facility is so back to we're talking about this 150-day commercial paper and unsecured 364-day facility. So this is just an example of a fictional company. Okay, we move on to fixed income indexes. Fixed income indexes function similarly to equity indexes in bond markets, but they differ in three significant ways. The issuer can have numerous fixed income securities outstanding, resulting in bond indexes having many more constituents than equity indexes. Some bond indexes include over 10,000 securities. The reason why you have so much more than equity is, remember on the first slide, we talk about a different dimension of bonds. So a bond has a lot more dimensions, which means that they have more permutations of different type of bonds. Bonds have finite maturities and new issuance occur frequently, thereby always generating more and more bonds, leading to higher turnover in fixed income indexes compared to equity indexes. Bond indexes are typically rebalanced monthly to include new issues and exclude those that no longer meet maturity criteria, which means that those are already either they are called or they have matured. Let's look at an example of a fixed income index. This is Bloomberg Barclays Global Aggregate Index, which is a very popular index to track the specific type of bonds. These issuers are fixed rate bonds from sovereign, government, corporate, and also securitized issuers based in developed market and emerging markets. So it includes both developed and emerging. These bonds are issued in 28 eligible currencies spanning across many different regions. This is only investment grade rating or equivalent, which means it doesn't include junk bonds. Coupon, fixed, zero coupon, step-up coupon. If you remember, we did talk about step-up coupon, which is coupon rates that increment as progresses based on the dates that are predetermined. Okay, so these are more some details that we don't have to go through. This just means that maturities that are lesser than a year are not taken into consideration when they are compiling this index. At each month end, the composition of the fixed set of bonds, okay. So like I said earlier, for the maturity that's less than a year, it will be removed from the index. And new issues will be included. And this is important because any coupon payments that you get, the interim cash flows will be reinvested into the index. This is based on the rebalancing date. So these are more technicalities that it's not that important in terms of understanding these bond index. But of course, it's important when you're actually computing the numbers, because yes, if you were to try to replicate the index, you need to make sure that you're able to replicate accurately. Okay, let's just move on. Now, okay, there are two types of fixed income markets, primary and secondary. Just like stocks, primary bond markets are where issuers sell new bonds to investors to raise capital. So for equity, it's raising capital from shareholders, while for bonds, it's just borrowing money from bondholders. So the difference between bonds and loan is because bond is a standardized instrument, and you can easily trade it in the secondary market, which is why we have a secondary market in place. Okay, this is the part that we talk about. Okay. And it's only during in the primary market where the company actually receives the cash borrowing from the bondholders. Any subsequent trading in the secondary markets is between investors. Bonds can be sold through a public offering available to any investors or via private placement. Yeah, so this is either you do it in a public or a private placement within the underwriters to selected investors. A secondary fixed income, so is a part where investors and participants, they can trade among themselves. So they include institutional investors, financial intermediaries, and central banks. The bid offer spread, buy from and sell to customers, key measure liquidity. So the tighter the spread, the more liquid it is. So we can see that for bonds that are older, you would have a wider spread. So how do we distinguish older or recently issued bonds? So the most recently issued or on the run sovereign bonds are usually the most liquid fixed income securities. What this is saying is that, let's say, for example, a 10-year bond. So there will be many 10-year bonds that, let's say it's just a US government bonds, there will be many 10-year US government bonds that are trading in the market. So the most recent one that is issued will be term on the run. And these bonds will be the ones that will be highly traded. The volume will be highest because they are like the most recent issued bonds. So once the next round of new 10-year bonds are issued, these older 10-year bonds are no longer on the run. And the reason why the on the run bonds are the most sought after is also because they are the bonds with the full maturity. Because you can imagine 1 year after a 10-year bond is issued, you will no longer be a 10-year bond in the sense that you will have a 9-year left in maturity. So on the run has the most number of years left in the bond. So primary dealers actively trade these in large quantities with bid offer spread as well as a fraction of a basis point. So 1 basis point is 0.01%. So you can imagine the spread is very low. But of course, bonds have very high notional amount. So multiplying by this 1 basis point can be still a lot of money. Among corporate bonds, those recently issued by frequent high credit quality issuers typically have the highest. Yeah, so this is like government bonds or corporations such as like Apple, Alphabet. Dealers often hold these recent issues in their trading inventory. So dealers are like the middleman. They hold these inventory and charge you a spread. But because they have so many of these issues in their inventory, they can get very competitive pricing among the dealers, thereby resulting in tighter bid offer spread. In contrast, bonds from less frequent corporate issuers, these are rarely traded. So for dealers to hold them in the inventory will be riskier. So this leads to higher spreads, at least 10 to 20 basis points, as compared to the one that is less than 1 basis point.